Here is price action. So if we look at this target chart, you see you have these big moves down in price, big moves down in price, big moves up in price. Yes, some of these are on earnings, but some of them are not. Big moves down in price. Now, what do you notice about these? Well, what happens in the subsequent days after that big move? Well, on this one, you had that big drop in price, and then the stock price moved up significantly on you. Big drop in price, consolidated sideways, moved up significantly on you. You had this big jump here, pulled back significantly on you, and just last week, big drop down, and what happened? Look, it actually went all the way to here, boom, coming right back up. You cannot trade just off of price action, and these are 4 or 5 perfect examples of why you cannot do that. Now look at this. What could you use instead? What's going to better you? Well, use trend. Use the trend line that's going to dictate it to you. And really, the only time you're going to ever truly trade, I shouldn't even say that. The only time you're truly going to go after something that's price action is you're going to jump to a day trading chart and you're going to try to trade that candle. You're still going to use trend, but that's the real time that you're going to go in and try to capitalize on a 10, 20% jump or fall. So with this one, this was actually pre-earnings. This was earnings. So you had this big fall in price. Let's see what this percentage was. This percentage fall was an 8% drop in price. Now, when you see something like Target, they come out, they report, they miss on the earnings side, they barely beat on the revenue side, stock price falls about 8%. Do you just sell? Do you just go short on it? Well, no, you don't, because your trend, even after this, look at this big fall, you started to circle back up. So if you were to just say, hell, I'm just going to go short on this thing, the next day it's just going to keep falling lower. It fell 8% today. Why won't it fall 8% tomorrow? Well, people are digesting news. People are digesting whatever came out. It doesn't have to just be earnings. And look at this. Over the next 2, 4, 6, 8 days, 7 days really, it was all the way back up to the price that it came from 7 days later. This is another example. There was no earnings down here. This was just something that happened. This thing fell in price. Let's see. We fell 2.25%, 5.34%, and 3.81%. So let's just round it out and just say 10%. The subsequent days, it went sideways. And then 3 days later, once it started to get that bump, look, came right back up to that price. Again, another earnings date here. This is if you're just trading purely off of price action. This is a great example right here. Earnings per share beat by 17%. Revenue beat by 1%. The stock price jumped up 10.3%. Well, to me, I would look at this and say, that was a hell of an earnings report. They just paid out a dividend. Stock was up about 10.5%. Why would this not continue to go higher? Well, look what happened in the subsequent days. It took maybe 2 weeks, but it came all the way back down to the previous price that it was at. My point in telling you all of this is you cannot solely trade price action. Don't think that because a stock price moves up or down a significant amount, it's going to happen the next day, or it's going to just keep happening over and over. Usually it's not. Usually it's an overreaction. People jump on the bandwagon. Then at that end of that day or the beginning of the next day, they take their profits and everything's gone and it goes in the opposite direction. Why? Because it was just people capitalizing on the price action move, on a 15-minute chart, on a 1-minute chart, what have you, but they're not in it for the long haul. And you, that's trying to get in it for the long haul, and by long haul, I mean maybe 5 to 10 days, you get completely thrown under the bus and you lose a bunch of money. So what would I rather you do? Pay attention to the trend. And honestly, what I like to do, when I see these big moves in price, I don't even trade them. I just say, all right, let's see what happens. For example, when Target fell here, Target fell significantly, 22%, 21.97%. And then the next day, it was about flat. It was down 0.11%. I don't participate here. Why? Well, look at the volume. Look how big that volume is. That is people just jumping on the bandwagon, like I just said. They're just getting in it because everybody else is getting in it. But they're going to get out of it that same day. You, thinking that you're maybe going to get into it for a swing trade, you're not. You're going to be stuck in it. And then the subsequent days, what happens? It rebounds right back up. So I like to pay attention to two things. I like to pay attention to the trend, see what's happening with the trend overall, and I like to pay attention to the volume. Let the volume normalize. When there's typically news that happens, you're going to get a spike in volume one way or the other, whether it's good news or bad news. Pay attention to that volume. If you see, like I'm going to look at Target right here, and I'm using Target because in the past year, 2 years, whatever it's been, it's had these significant jumps that have completely reversed very quickly, like you've just seen in these examples. But look at this. You average about 7.71 million shares traded per day. Very normal, right? All through here. Very normal, very normal. But what happens? You have this big spike right here. You have this big spike right here. You had a big spike of here. You had a big spike in here. Don't trade big spikes. Don't worry about big spikes in volume. Just let them go. Let them go. Let things settle down. Then, once you get this big move up to the top, reassess the next day, reassess 2 days later, then go ahead and get into your short because you're trying to fill that gap. You're not chasing that initial price action. It's one of the worst things that any trader can do, especially a new trader, because they'll get in, they'll find some guy on YouTube, he'll say you need to load up on this stock because the stock price is going up, and then the next day, boom, it goes in the opposite direction. Why? Because nobody knows what they're looking at except for a price jumping up on you. Typically, when a price jumps up, it's going to come right back down. All right, I want to show you one other example here, and this is Alibaba. And this is a great example because price action plays a very, very significant role, not just in Alibaba, but a lot of stocks that are coming out of China. Why? Because you have a lot of news coming out, a lot of economic news saying that U.S. is going to work with China, U.S. is not going to work with. Every single day, there's something different going on. China is going to attack Taiwan, therefore the price is going to go up, it does, or down. Every day there's something. And this is very interesting. So let's look at this. We come through October here, September into October. You had very, very large spikes in volume. Remember, this is the abnormal volume that we're talking about, which leads to what? Massive price action. Price action that jumps. Then you come down a little bit, and it jumps, and it jumps, and it just keeps jumping. If you were to just trade the price action on any of these days, you could see that it just zigzags around and significantly. And once the negativity comes in on it, you do have that negative price action. But what happens? Look at this, guys. Big pull down, rally back up. Big pull down, rally back up. Big pull down, rally back up. My point in saying all of this is I don't want you to just trade prices that are moving down or prices that are moving up, because they're going to reverse in that opposite direction. So you may be asking, well, am I going to miss things? Am I going to miss things? Am I going to miss big moves in volume? It's possible. It is possible, because what happens with price action? Well, you're going to get a big move up. So if we're looking at this, yeah, there's a chance that you miss a 10% run up. But that's also considered luck to me, because you can have this move up that happens in the morning, and during the day, it starts to pull back. Price action, really, it's nothing more than luck if you're catching it on I don't even want to call it a consistent basis, because nobody can trade price action on a consistent basis without the use of some other indicator. Some other indicator being volume, some other indicator being trend. I personally like using the trend. If you want to have a career in trading, or you want to have any type of longevity in trading, I would implore you to use some other type of indicator. And to me, trend and volume work perfectly well, and they work over a long period of time. And that's the great thing about those two indicators. There's other indicators out there. They could work, but are they going to work for a long period of time? This has worked over a 21-year period. Now, you could be looking at this saying, okay, that's great, and I understand what you're saying from preliminary level, but how do I learn this? Well, it's very simple. We have a great video for this. It covers everything that you need to know about trend, and we have a community that talks about this. So everybody in the community has been watching this video. It is phenomenal. Go and check it out. You're going to understand why you use these indicators.